Welcome, students, to the series on LO2. So this series comprises of basically 3 videos. So the first video, we are going to be talking about question 1. We're just going to do an explainer on question 1 in the first video. Video 2 will be an explainer on question 2. And then our third video is going to be how to mark. So if you're just looking for example, an explanation on a specific topic or a specific question, or if you only want to know how to mark, then watch the appropriate videos. The other thing that I need to tell you guys is that the question will be available on ClickUp as well as the solution. So please download those now, because the screen that you currently see on your or the page that you currently see on your screen is as much as possible that I can zoom in. So I can't go any more. I can't zoom in any more. So if you are struggling to see, or you need to understand what I'm talking about, then I would suggest that you download those PDF files and then have a look at them while watching the video. So therefore, it's important for you to have the question as well as the solution while you watch these 3 videos. As explained, the first video, which is this one that you're watching, is on question 1. So let's get straight into it. So obviously, I'm not going to spend too much time on the general topics of the test. As you guys know, this is what our tests generally look like, specifically the year tests. So you'll see that we will indicate on the front cover what exactly is being assessed in what question. It can be quite beneficial for you to read through these topics. For example, we know that when we come to question 2, we were seeing a lot of answers that were irrelevant or not in line with what we are asking. And that's maybe because we didn't read through and see that we wanted, for example, accrual basis of accounting to be tested then. So I would suggest that you read this first page properly, and then also note that we don't accept pencil or erasable pens as answers. So they're not marked if you do write in pencil. So yes, you can draw your tables, if there are any tables or T accounts or such things in pencil. But if you actually write out your answer in terms of numbers or words in pencil, that will not be accepted as an answer at university going forward. Okay. So let's get then into question 1. We'll start off by reading. So I'll read a section of the question, and then I'll show you what that should look like with an explanation, what that should look like in your solution. Remember, we're not going to spend too much time on the allocation of marks or how to mark your paper, because that is coming through in video 3. So let's then start off by reading our question. How do we normally read a question? Many students will open up the question paper and start right here at question 1 at the heading. But we need to remember and learn that we have to always start our questions on the required page. So you'll see I jump straight to the required page and I start reading the required first. So let's have a look at what the required is telling us. So this required, which is the required for question 1, says prepare the general journals in the prepare the general journal entries in the general journal of N Hall Cement Traders for the month ended January 2023. So we need to make sure that we're constantly referring back to the reporting period, which in this case is the month of January 2023. That means we must be very careful to exclude things that fall outside our reporting period. Okay, then you'll always see at the end of our questions that we say in accordance with IFRS, and that is just to remind you what we are basing our tests and our solution on, and it's based on IFRS. So not GAAP, for example, although IFRS is a culmination of GAAP, there might be some small differences between IFRS and GARP that you will learn about. So not GARP, not GRAP, not any of the other frameworks that you and I will talk about in the second semester. We specifically want to focus in on IFRS. Okay, so that's the first point. Notice also the mark allocation, 35 marks in a 40-mark test. That is significant, which means we need to make sure we score as many points, as many marks as possible in this question, because the next question is just a small sort of filler question that's going to come up, and you're going to see that question in video 2. Okay, so let's have a look at what the note says. Right, so the note says round all final amounts to the nearest rand. So many students will be confused about rounding. Here it's clear only the final amount needs to be rounded, which means when you're doing a calculation and you've got multiple different amounts that you might need to calculate. For example, you might need to calculate depreciation for year 1 part of the year 2 part of the year, and so on. We're not wanting you to round those intermediate amounts, the amounts arriving at the final answer. Only the final answer needs to be rounded to the nearest rand. When we say nearest rand, that does not mean round up, nor does it mean round down. It means that if you have an amount between 5 and so if amount has 0.0 or 0.5, right, it will go to the smaller number, so it will go down. And if it has 0.6 up to 0.9, it then goes to the higher number. So that's what we're trying to say. So you can both round up and down when we say to the nearest rand. The next note says cash and credit transactions, where applicable, should be included in the general journal. This means that we are not expecting you to prepare any other journal. So not the CJ, CRJ, DJ, none of those are required to be prepared. Instead, all of the entries that would have gone into those journals are going to now end up in the general journal. That's what this note is attempting to say to us. The next thing that I noticed many students missed is that at university, we always want you to disclose and tell us what element or what part, what financial statement this is going to affect. So, for example, when you're passing a journal entry, we want you to say SPL, meaning that it's going to go to the profit and loss statement. OCI, which is going to go to the bottom part of the profit and loss statement, right? So the bottom part of the splocky. For example, in first year, the only OCI that we'll be dealing with is revaluation on immovable property. So we already know what exactly should be going to OCI for our purposes for first year. So there shouldn't be any confusion around that. Equity. So if anything is going into equity, we need to write down the word equity. And then finally, everything else, so basically except equity, so assets and liabilities, should be tagged with SFP, meaning that it's going to the financial position. Then it says unnecessary journals will be marked negatively. You will see that coming through in video 3, where we talk about how to mark. It says closing entries are not required, okay? Also, this is an important one. Journal entries must be dated correctly, okay? So you have to have your journals being dated. We've noticed a large amount of people that weren't dating their journals. Instead, they were returning the question information points to us, and that's incorrect. That's not good exam technique. Instead, good exam technique will be to plan out your journals, identify the journals that will be issued first or processed first in the month, and then do those ones first. Narrations are not required. Ignore tax implications. So you won't really do tax implications until you learn tax. And then the next one is, if we did not mention any assets, right? So other assets that the entity might own, you should ignore depreciation on them, right? So if it's not included in our information above, don't worry about processing depreciation for them. The next one is show all show all calculations and use cross-referencing, right? So that we can match up the amounts to the calculations. And then finally, assume that all amounts are material. So now that we know what we need to do, so we need to process journal entries, we need to follow what is being said to us in the note before and during the process of processing our journal entries. Now let's go back and read the actual information on the question, right? So if we have a look at the first paragraph, so I'm reading the first sentence in the first paragraph, we hear that N Hall Cement Traders is a manufacturer of specialized cement. Mr. Nathan Hall started the entity as a sole trader. So now we use an abbreviation. So this is also something that is very common in university papers, is that they often will abbreviate the company's name and or important or key people. So you notice that N Hall is now abbreviated to Mr. Hall, and the company or the entity is now NHC. So NHC, so I'm reading the third sentence at least. NHC mixes cement to meet the specifications of customers. The entity also sells construction tools and consumables, okay, which include sandpaper, saw blades, machine oil. The entity owns one physical store located in Hatfield, Pretoria, next to Mr. Hall's private residence. Now, already that sounds strange, so we need to keep a track of what happens with this private residence versus the store location. It sounds strange that that information will be included or shared with us in general information at the start of the question. So let's just keep a track of what happens with that story there. So NHC uses the perpetual inventory system and is not a VAT vendor. NHC has a 31 December financial reporting date. Okay, cool. So it lets us know that if we're recording in January, we're recording the first month of the year, right? So that's what we need to keep in mind and remember as we proceed with our recording. Cool. So it says Mr. Hall is unsure of how to account for the following transactions that took place in January. The first one says the store and Mr. Hall's private residence use the same prepaid meter. Now, you guys would remember that we did do an example of an electricity meter, prepaid electricity meter in class. So this was actually pulling on that example that we did in class. You'll remember we did it when we were talking about the accounting equation. So this first one should be really simple, and we should have scored all the marks related to this specific example because we actually did something very similar to this in class. So let's have a look at what we need to do. It says on the 1st of January 2023, there was an unused balance, right, of 800 Rand. Now let's think about that. If it was an unused balance at the beginning of the month, what then would we have recorded this electricity balance at in the previous month, right? In the previous month, we would have paid for it because remember, it's prepaid, so you buy it ahead of time. Now, in the previous month, because we had paid or purchased it, that means that when it entered our financial records at the beginning of the current month, it would have been a prepayment. Okay? So we need to keep that in mind. Now, what happens with a prepayment at the beginning of the next month, or in our case, the beginning of the current month? What we need to do is we need to say we are likely to use this electricity. So in this month, this electricity is likely to become an expense. So we need to unwind or release that prepayment. So that means we de-recognize the asset and we then recognize an expense in its place. So that is what we need to do with the 800 Rand. We read further that while on the 31st of 31st of January, there's an unused balance of 500 Rand. So they've basically given us the opening balance as well as the closing balance in one sentence. We need to be able to split that. One is us eliminating or releasing the prepayment, right? That being the 800 Rand. And the 500 Rand is us recapturing a prepayment at the end of the month. So that's what we need to do here. That is why we're passing the journal entries. It's not so good to know what journal entries to pass. We need to understand why we're passing them, right? Because the one is us assuming that we're going to use up the electricity, right? The 800 Rand in this month. And the 500 Rand is us saying we haven't used this, so we have to record it as a prepayment for next month. Okay. Then we continue on with the next sentence that says there was only one purchase of electricity during January 2023, which amounted to 9,700 Rand. This purchase was paid for via EFT, right? So that means it came out of our bank, right? Although the examiner didn't need to really tell us that it came out of our bank, because clearly, because it's prepayments, it means we've paid it in advance. So we should have actually paid it with a bank account. But just to make sure that there's no confusion, and that we don't think that maybe we borrowed from the bank or whatever to pay this electricity, the examiner here has kindly informed us that it has actually exited our bank account. So we need to remember that in this journal entry, we should be crediting bank, okay? Then it says the allocation of electricity consumption between the business and private use is determined on the last day of every month, okay? So it's not determined before the last day of every month, which means in our journal entries, the allocation also needs to be done on the last day. So the dating of your journal entry here is going to be really important. We must date it as the 31st of January. Okay, so the dating is super important. So it says on the 31st of January, NHC determined that 45% of the electricity used during the month related to Mr. Hall's private residence. Okay, cool. So let's start off by first journalizing what needs to happen on the first of the month, right? So let's just start off with the opening balance of 800 Rand that we just read about. Now let's see what that would look like if we process the journal entry. Now we're going to skip over to the first page of the solution. So if you've got that printed out, or if you've got it on a screen close by, just switch to the first page of the solution, and you will see that on the first, right? So under date, the 1st of January, we process a journal entry that decreases the asset and increases the expense. So what we're saying is we had this prepayment in the prior month, but now we are sure that we are going to be using this prepayment using up this electricity during the current month. So it doesn't make sense for us to leave it as a prepayment, as an asset. So instead, we unwind or release it from being an asset and we create an expense. So that's what we're doing here. So we debit expense, credit the prepayment for an amount of 800 Rand. That's the first journal entry that needs to be passed at the beginning of the month. Then if we fast forward to the 12th of the month, and that is going to be on page 2 of your solution. So go to page 2 of your solution, and there you will see that we are now recording the payment of electricity. Now, because we don't know how much the electricity, at this point on the 12th of the month, we don't know how much of the electricity is going to be prepaid at the end of the month. We can't split, right? We can't split the payment of 9,000 Rand for electricity between the prepaid amount versus the amount that will be expensed. So what we do is we send all of the payment to expenses, because we might actually use up all of it. So it makes sense to recognize it based on its actual form. So in this case, its actual form is that we're paying for an expense. We're not sure that we're going to have a prepayment. So therefore, we shouldn't be recording the prepayment on the 12th, because there's too much of variability. There's uncertainty around the amount that will be a prepayment. So we can't record the asset. Later on, when we start in the second semester, when we start talking about assets and liabilities, you'll realize that for an asset, you need to be very sure before you record it. Whereas a liability, even if there's a little bit of uncertainty, you can record a liability. But here, all you need to know is because there's uncertainty around the amount that will be prepaid at the end of the month, we therefore need to record the whole 9,700 Rand as an expense, which is what we're doing here. So we debit the expense, we credit bank. Okay, then we fast forward now to the end of the month, which is going to be on, it's going to be on page 4 of our solution, right? So if we have a look at this page, page 4 of our solution, we'll see what we then do on the 31st is we now know that 500 Rand is going to be a prepayment. So we decrease our expense by crediting it, and we debit or create the prepaid expense for 500 Rand. Again, the reason why we're doing it is because we haven't used it, but we're sure that we will be using it in February. So therefore, we need to exclude it from the January's expense and make sure that it is an asset so that when February comes around, we can do the process again of unwinding it and making it back into an expense. And then the tricky part of us splitting. So again, notice the date is the 31st because in the question we are told we can only split it on the 31st, right? So we on the 31st, we now say a portion of this electricity is drawings or belongs to the owner. The business paid it on behalf of the owner. Because of that, we can't include that in the business expense. Now, this I noticed a lot of students getting confused with this part because the amount that we remove is the amount that relates to the owner's usage. So if we just swing back to the question just briefly, I just want to show you something here. It says that, so in the question, as we read point 1.1, it says there that NHC determined that 45% of the electricity used during the month related to Mr. Hall's private residence. Now that's the amount we need to remove. So we need to remove 45%. A lot of students were actually removing 55%, which makes no sense because these are the accounts of the business. They're not Mr. Hall's accounts. So the amount that we remove should not be it should not be the business's electricity. It should instead be Mr. Hall's electricity. So that's why we're removing 45% of whatever went in to electricity expense for the month. So we know that at the beginning of the month, we debited it with 800 Rand. We then added on to that 9,700 Rand, and we removed at the end of the month the 500 Rand. So whatever is left needs to be split. 45 goes to Mr. Hall, and the 55 remains in the expense account because these are these are the accounts of the business. So we see that we debit drawings and credit our expense, meaning that we decrease our expense, and the amount there is 4,500 Rand. That's the amount that we are removing. Okay, so that is point 1. So those are the things that we needed to do for point 1. Let's go back to the question and we'll read point 2 and then we'll discuss it and record the journal entries for it. Now, so point 2 starts off by saying on the 1st of January, Mr. Hall purchased a Ford Ranger that was used as a delivery vehicle by NHC. This is the first and only motor vehicle owned by NHC. This vehicle was purchased second-hand for the advertised price of 250,000. The advertised price. The dealership granted NHC a 20% trade discount. Now that's important. Trade discount. When you guys chat about discounts, you'll see that there are different types of discounts. We've got a bulk discount, a trade discount. Those discounts are excluded from the price recorded in the general journal right at the very beginning, because the company never pays the advertised price. They always only pay the discounted price. But whereas with a settlement discount, the company at first is unsure as to whether they would get the whole settlement discount or whether they would get whether they would have to pay the advertised price. So that's why you find the difference in recording when we talk about settlement discount or rebates. But when we talk about trade discount and bulk discount, you'll find that we always only record the discounted price, because there's no question as to whether or not we're going to get the discount. It's definite. We're definitely getting it, because the mere fact of us doing trade with this business means that they are willing to give us a discount. So it's guaranteed. A trade and bulk discount, those are guaranteed, whereas settlement discounts and in some cases rebates are not guaranteed. So we just need to be really careful, read very carefully. So here we hear that it's a trade discount, which means we know that the amount we record needs to be the discounted price. Okay. We then hear that NHC took delivery of the vehicle on the 1st of January 2023. The vehicle is available for use as intended by management on the same day. Remember what we spoke about in class? We said that we only depreciate vehicles, or we only depreciate assets when they are available for use as management had intended. So now we know we can depreciate it from the 1st of January. We then told that NHC funded the discounted purchase price. Notice, not the advertised price, the discounted purchase price of the vehicle with a finance agreement or loan from West Bank. The loan is repaid in equal annual installments. Okay, loan is repaid in equal annual installments over a 5-year period. The first installment is due at the end of this year, right? Because it's annual installments, so one installment per year. So the first installment is at the end of 31st December 2023, the end of this year. The loan from West Bank accrues interest at an effective interest rate of 12%. Now, what do we do with this information? Let's just understand what happens. Do we think that when we get a loan from a bank, right, that the bank is going to deposit all of the money into our bank account and then we are going to pay it over to the dealership? No, that's not what happens. Think about, for example, if you get a loan from the bank, they don't deposit the money into your current account. They instead will pay directly the vendor. That is why when you go to buy a vehicle, and some of you may not be aware of how this all works, but when you go to buy a vehicle, you need to make sure that the bank is in contact and knows the person from whom you're buying the vehicle, because the transfer of the money does not come via the person getting the loan. The transfer happens from the bank to the vendor, and then the vendor releases the vehicle to the person buying the vehicle and the person obtaining the loan. The person who obtains the loan does not see this money in his bank account. Now, many students made the error of saying first that we want to credit loan and debit bank, and then credit bank and debit vehicles. Now that's incorrect. That's not the economic substance, because what you're trying to say to the examiner is that, oh, my bank has increased, but your bank hasn't. It's not your money, right? So you should have never recorded a debit bank. You should never have that journal entry on your side of things, because that's incorrect. That's not the economic substance. That's not what's really happening in this transaction. In this transaction, we are getting a asset for a liability. So our journal entries needs to be an asset and liability. It can't be an asset and an asset, or any other way. So we can't have, for example, debit an asset being vehicles, credit bank, which is also an asset. That's incorrect. That's not the economic substance. Here, what is happening in this specific transaction is we are getting a new liability for a new asset. So that's what our journal entries need to show. They need to show us getting a new asset being vehicles for a new liability being the loan. That's the only journal entry that we need to process. Anyway, let's read on to 2.2. Says that NHC calculates depreciation on a straight line method for estimated useful life of 10 years. The vehicle has an estimated insignificant current residual value, and these have remained unchanged since the purchase date. We then see that they've actually calculated depreciation for us correctly at 1,667 Rand. So let's see how we're going to process these journal entries, right? So on the 1st of January, you'll see that we have a transaction here that is simply debit vehicles credit loan. We do not see this amount coming through our bank account because, like we just discussed, it's not the economic substance. We're not exchanging a liability for cash. We're exchanging a liability for a physical vehicle. So therefore, our transactions need to disclose or show the person what is actually happening. We also don't want to have unnecessary additional transactions in our GL account, because what that does is it creates a lot of basically junk transactions, junk journal entries in our ledger, and that can create when the auditors come around. So we want to record it in the most pertinent way, the way that gets to the point. And so that's why you'll find our journal entry is debit vehicles credit loan. Okay, so the amount, we take the advertised price, which is 250,000. We then actually decrease it by the 250,000. We then actually decrease it by the discount that we got. So because we got a 20% discount, we take out 20%, which gives us 80% of the advertised price, and therefore we record only 200,000. Notice the trade discount does not get journalized. We don't journalize the trade discount because it is a guaranteed discount. There's no need for us to record it in any other way, because basically for our intents and purposes, the value of this vehicle was never 250,000 Rand. The value of this vehicle had always been 200,000 Rand. And so that's what we need to show in our accounting records. Okay, so let's then skip to the end of the month. So notice now our dates have changed. Our date is now 31st. Then we record the depreciation. Most of us did this correctly. Obviously, debit depreciation, credit accumulated depreciation, we were very good with that, and the amount of 1,667 Rand. The thing that people missed was in the question, implicitly, they were telling us that we have a new liability, right? So if you read point 2.1, the last sentence there tells us that our loan accrues interest at 12% per annum. So we had to record the interest on the loan, you see. So now the next journal entry that we need to pass in relation to this vehicle is the interest on loan. Now, what we're going to do is, you'll see we are going to debit our expense. Now, we said it can be interest expense or finance cost. Some people might use finance cost to be actually accurate in the way they record it. But even if you did interest expense, that was accepted. And because we didn't tell you whether this would be capitalized, we therefore said if you say accrued expenses or loan, that would be Fine. Notice there is no bank here. So there's no credit bank, meaning we're not decreasing our bank. Why? Why are we not decreasing our bank? Right? So that's the question. Why are we not decreasing our bank? Let's swing back to the question, and you'll see that we say the first payment is only happening when? That's correct, on the 31st of December 2023. So the question was very clear that there was no payment going to be made in relation to anything else that has to do with this loan. The only payment is happening at the end of the year. So therefore, it's incorrect if we have bank as, so basically the asset, if we decrease our asset in this journal entry. Instead, we need to realize that it's going to accrue, it's going to become accrued expenses. Um, so, so that's what this journal entry is. So debit, interest expense, credit, some sort of liability, either loan or accrued expenses. How did we calculate the amount? Notice we only financed the discounted price, so only 200,000 multiplied by the 12% effective interest rate, and then we divided it by 12 months because we're only recording for January, so therefore we're only recording we're only going to record 2,000 Rand. So that is what the journal entries look like for point 2. Let us go back to the question and move on to point 3. Okay? In point 3, we say that on the 2nd of January, Mr. Hall purchased 5 new cement baggers, right? And then the examiner tells us here that it is actually equipment that we need to be recorded. Just in case we were confused, they wanted to be very sure that we knew it was equipment that this relates to. When we talk about cement baggers, right? It's not cement bags. So I've noticed many students were recording inventory. When we say cement baggers, means that it's a machine that actually packs cement into bags. So it's a machine. It's not cement bags. So therefore, the examiner was very kind here to tell us that it's actually equipment that packs cement into bags. So we were in no doubt that this is a machine, and we need to be recording it under the equipment label in our financial records. It then says Mr. Hall purchased this equipment. Again, the examiner is emphasizing that it's equipment from Bomac Industries Limited, and the amount that they purchased it for was 180,000. Now, at the top of the next page, you'll see that Bomac Industries extended credit to Mr. Hall in the form of a personal cash loan. Question: who did they extend credit to? They extended credit to Mr. Hall. Did they extend credit to NCH or NHC? No, they didn't. So should we be recording any sort of trade creditor? Should we be recording any sort of long-term loan? No, because the person whom the entity has given credit to is not the business. It is the owner in his personal capacity. That's why, again, the examiner emphasized it's a personal cash loan, right? So it's for Mr. Hall's person that he got this cash loan. It then says that the value was for the 180,000 for the equipment, and Mr. Hall is going to pay this loan back from his personal bank account. Okay, Mr. Hall used the cash to pay for the new baggers. Now it says the new baggers were available for use. So far we're only hearing about Mr. Hall buying equipment. It had nothing to do with NHC until 3.2, because in 3.2 we now find that these baggers are now being used by management from the 1st of February. Therefore, the equipment should only be depreciated from the 1st of February. The equipment is depreciated on a straight line basis using a straight line basis over 6 years as its useful life. So, what we've now identified is that Mr. Hall has gone out and bought equipment, right? He took a personal loan, he bought equipment. And then the business now begins to use this equipment. So, what exactly do we think that is, right? What is it when a owner takes his personal equipment and gives it to the business, right? Very similarly to when an owner takes his personal money and gives it to the business, it's called a capital contribution. In the same way, when an owner takes his personal equipment or a personal asset and gives it to the business, it is a capital contribution. So we already know what our credit leg of the journal entry is going to be, right? There we can see we're crediting, so in the middle of page 1 on the solution, we are crediting capital. We also accepted owner's equity or even capital contribution, right? So we accepted all of those because the owner is giving it to the business. Notice we did not accept any liabilities. So if you did trade creditors or trade payables, that was incorrect. That should not be there, right? Nor should we have bank here as well, because clearly there was no decrease in our bank account on the credit side. So we shouldn't be saying bank or liabilities being the credit leg of our journal entry. The debit leg is easy because it was emphasized so many times. It's equipment. It's not inventory, because remember, inventory has a short lifespan. Inventory is what we call a current asset, meaning that in 12 months we should expect that inventory should be used up by the business, or another word is extinguished by the business. But for equipment, the usage and therefore the useful life is a lot longer than 12 months. So therefore, if we recorded inventory as our debit, that would have been incorrect. And the amount was 180,000 Rand. Now, should we be depreciating this asset? Clearly, because we only need to depreciate it from the beginning of February, it has no effect on our reporting period, which is January. So there's no journal entry that we need to record for 3.2 because there's no depreciation taking place in January. Are there any loans or anything else that we need to maintain? No, because remember, this was a capital contribution. Let's move on to point 4, which is on page 2 of your question. So go to page 2 of your question, point 4. On the 6th of January 2023, Mr. Genie purchased 4 identical saw blades for his table saw on credit. Okay, the total selling price of all the saw blades was 8,000 at least. So the total selling price of all the saw blades, he bought 4. So all 4 of them, if we added the cost, the selling price up of all 4 of them, we came to a total of 8,000 Rand. Okay, that's what this question is trying to tell us. So for those of us that took 8,000 and multiplied it by 4 and got 24,000 and recorded a journal entry of 24,000, it's clear that we did not read the question carefully enough. Okay, we then go on to hear that the total cost price is 6,000 Rand. Okay, this was the first purchase that Mr. Genie ever made on credit. Okay, now that's going to become a little bit more important later on when we talk a little bit later on about Mr. Genie. So what we need to do is we need to pass our revenue journal and our cost of sales journal. I would like us to learn to process these journals as separate journals. It's not nice to have one journal. It's very difficult to mark. and also it confuses the student doing the journal, because when we have more complex journals later on in the year, you're going to get confused. So what we should be seeing in this journal is debit trade receivables, right, which is a debtor and the name of the debtor, so Mr. Genie, and credit revenue. That is the journal entry that we should be processing for the revenue element. And then in a separate journal entry, we have the cost of sales element, where we say debit cost of sales, credit inventory. So we decrease our inventory because we've used up this inventory and sold it, right? So we shouldn't be confusing these two journal entries and mixing the amounts and the accounts together, because that creates problems when we're marking, right? So just pay careful attention to that going forward. And the amounts, 8,000, 6,000. Notice only half a mark was awarded for these two amounts, and that's because we simply plucked them out of the question. So there wasn't much thought that needed to go into it from our side. Okay, let's go back to the question, and now we want to look. So what we're going to do is we're actually going to follow Mr. Genie's story, right? And we can only do this once we've read the question a few times. So when you get your question, guys, let's not just start recording as we're reading. We need to read the whole question from beginning to end and then go back and read it a second time. And only then should we start preparing our answer, right? And that gives us some insight, some planning that we can do in order to make sure that our answer is complete and well formed, so that we're not missing any journal entries. I noticed that a lot of students left the test early, and that's showed in the assessments, because it showed a lack of planning. They were unable to plan. They didn't know what they were doing. The journal entries were incorrectly dated. They were in different order. And although you are not penalized for that, it shows that the student is confused, doesn't know what they're doing. And we want to get that stuff down now, because later on, when actually the content is so difficult that we need extra time, this planning process will come into play to make sure our answer is better. So if we skip, so the last one we did is number 4. We're going to skip 5 and 6 just for now, and I want to look at number 7 on the question. So on page 3, so if you go to page 3 of your question, 7. So if we look at point 7, it says that Mr. Genie on the 15th of January returned 1 saw blade. See point 4 above, right? So point 4 is where he purchased it. Now he's returned it, as the saw blade was did not fit his saw, but it was in good condition. Now notice in point 4 they used this word here, identical. They said there were 4 saw blades that were purchased and they were identical. And now we're told that he returned 1, which means what is going to be the price of that 1 blade that he returned? Correct. It will be identical to the other 3 blades. So that means we can take the 800,000, which was the selling price, and divide it by 4 and get the individual selling price for this 1 saw blade that was returned. If there was the word, if the word identical was not there, we would have now needed to find another way to distribute the selling price. And there are other ways, but for now, we just need to know that that word identical or the same needs to be in the question in order for us to divide the selling price the way we did in this question. So now let's go to the 15th of January. We're going to find the 15th of January on page 3 of your solution, right? And we see right at the top of the page there, we reverse. So it's simply the same journal entry that we would have passed when we purchased it, only this time it's in reverse. So instead of debiting trade receivables, we're crediting it and we're debiting revenue or sales returns, and the amount is 2,000 Rand. We got that by saying 8,000 divided by 4. Same story with the cost of sales journal. We debit inventory, credit cost of sales, 8,000 divided by 4, and we're getting 1,500 Rand as our journal entry. So that is what happens with point 7. Now, I also just want to have a look at the last point that relates to Mr. Genie. This is on page 4 of your solution, of your question. Page 4 of your question, we're looking at point 10. Page 4 of your question, we're looking at point 10, and there it says Mr. Genie paid the outstanding balance, and we need to look at point 4 and 5 and 7 to figure out what the outstanding balance is. This payment was done on the 25th, you see, of January. So let's go and have a look at what we need to do there. So on the 25th of January, what you will see is that we, I'm just scrolling to the 25th, just 1 minute. Sorry, so it's on page 4 of your solution. No, it's wrong. Page 3 of your solution, and you see we've got a journal entry there, debit bank, because clearly Mr. Genie was a debtor. So if we say he settled his account, it means that he can't pay that one debt by creating another debt. So it has to be that he's paid it with money in our bank. So therefore, we debit bank, credit trade receivables for 6,000 Rand. How did we get the 6,000 Rand? We said 8,000 Rand, which was the original journal entry we passed, arising out of point 4. That was on the 12th. Then on the 15th, he returned, right? And that was coming out of point 7. He returned 2,000 Rand. So the remainder was 6,000 Rand. Okay. So that is the journal entry for information bullet point 10. Now let's go back and have a look at bullet point 5. Remember, we stopped at 4. So we'll go back to 5. And we see on the 8th of January, right? On the 8th of January, NHC and the University of Pretoria signed an agreement for 10 tons of a new type of cement. The agreement was as follows. So we see that there's a refundable deposit. Why is it important that it's refundable? It's a refundable deposit, right? We'll get to that just now. The purpose of the deposit is to compensate NHC if the equipment is damaged during the production process of the new specialized cement. NHC will refund the deposit to the university if the equipment remains in good condition. The amount of 10,000 Rand does not form part of the selling price. So it's clear here that this is not income, right? Why? Because income means that there's a possibility that we could, this amount of 10,000 Rand could end up in revenue. But after reading this, it's clear that we're either going to refund them or we're going to use the 10,000 Rand to repair our machines. So under no circumstances will this 10,000 Rand ever end up as income, right? Which means recording it as income received in advance is wrong, right? Because it's not going to be income. Does that make sense? It will either be refunded to the customer or it will be used to repair the machines. It's never going to become income. So we can't record it as income. Does that make sense? Right? We can't record it as income. Okay? So that's point 1. The next 5.2 says that the 10 tons of cement would cost or would be sold for 60,000 rand and would cost us 30,000 rand to produce. A payment was made by the university. So the university jumped the gun and made the payment early. A payment was made by the university of 70,000 rand. What do you think that 70,000 rand is made up of? It's firstly the 60,000 rand selling price plus the refundable deposit of 10,000 rand, right? So the university paid early, okay? We then see that NHC invoiced them in relation to what we just read only on the 31st of January, okay? And the refund was made to the university on the 2nd of February, okay? So when we're recording this, it's clear that on the 8th of January, there was an increase in our bank account because we are told it was made by EFT. So we know we need to have debit bank 70,000 rand. The contra entry to that can be number one, income received in advance 60,000 rand, or trade creditor 60,000 rand, right? Both those accounts, income received in advance and trade creditors, are a liability account. But what is incorrect is for us to say trade receivables or debtors control 60,000 rand. Because now we're saying that we've received an asset. We're saying that our bank is increased and we've received an asset at the same time. So if we said debtors control, that's wrong. We needed to have said trade payables or creditors control. But the most correct thing to record the 60,000 rand as would have been income received in advance, right? With the 10,000 rand, it would have been conceptually incorrect for us to record income received in advance. Why? Because there was never a chance that the 10,000 rand would become income. So therefore, we need to record a liability that shows the examiner that I understand this amount is never going to become income. So the account name, instead of telling you what the correct account name was, it's easier for me to tell you what it shouldn't be, and it shouldn't be income received in advance. It could be trade payables, though, right? That's fine. It could be trade payables, but in the solution, we've taken the position to go with refundable deposit. However, you'll see at the top of page 2 of the solution, if you put the whole thing into trade payables, we would probably accept that, right? We'd also probably accept income received in advance, although we've just discussed why it's conceptually probably accept income received in advance, although we've just discussed why it's conceptually incorrect to say income received in advance. So what you need to do is you needed to have gone debit bank 70,000 rand, credit trade payable 60, credit refundable deposit, which is a liability 10. Okay, so that is the journal entry that you needed to pass on the 8th. But we've also heard that on the 31st, we actually transferred the goods to the customer, and the revenue was therefore earned. So if we now jump to page 4 of your solution, you would see there that what we're doing on the 31st of December is we are saying now we need to eliminate this trade payables, right? We eliminate trade payables by debiting it. We credit revenue for 60,000 rand, and we also should not forget about the cost of sales journal entry. So we debit cost of sales, credit our inventories for 30,000 rand, and both those journal entries happen on the 31st. So we just need to watch the dates. We need to watch the dates with those journal entries. It's very, very important for us to watch the dates because there may have been a penalty applied if we got the dates wrong. Okay, so those are the journal entries that we would pass for the transaction under 5. Then 6 tells us that Sibanda Secondary School purchased 12 drill bits for a school construction project and paid in cash. Mr. Hall identified that they needed 15. However, Sibanda could not afford the additional 3. Mr. Hall delivered 15. So they purchased 12, but he delivered 15. So he delivered more than they purchased, right? And 12 of them were purchased, 3 of them were donated. Each drill bit, right, had a cost price of 50 Rand and a markup on cost of 50%. So if a markup on cost is 50%, what we then need to do when we're calculating the selling price is we say, what's 50% of 50 Rand, right? It's 25 Rand. So if it's a markup on cost, we say 50 Rand plus 25 Rand, our selling price should be 75 Rand, right? So that is our selling price, and whereas our cost price is going to be 50 Rand. So let's see how we can process this journal entry. So in this example, the examiner only gave us the cost price and wanted us to work out the selling price. Okay, so we're going to go to page 2 of our solution. On page 2 of the solution, we'll see bank. We debit bank. Why are we debiting bank? Because we're told that they paid with cash. Remember? So we debit bank and we credit our revenue. Now this is a journal entry very similar to one that we had already passed. Okay, so we should have gotten this one right. What we then did is we said 50 Rand, and we increased it by 50%. So we got 75 Rand, and then we multiplied it by the 2 that were 12 at least that were paid for. So because 12 were paid for, we got an amount of 900 Rand. When we come to the cost of sales journal, and this is one reason why we shouldn't be joining, I noticed a lot of students were merging these 2 journal entries into one journal entry and mixing the amounts up. And when it came to this transaction, they were getting super confused, because as the transactions get more and more complicated, it's going to become more and more important for you to separate your revenue journal from your cost of sales journal. So here in the cost of sales journal, what you see is we have an additional leg. So we debit donations and we debit cost of sales, and we credit our inventory. The amounts, obviously 3 times 50 for donations. That's because the cost price was 50, 3 of them were donated, so 3 times 50. The 12 is going to come in as cost of sales, and the total is what we decrease our inventory by. Okay, so those are the journal entries that we pass in relation to Sibanda. Then on page 3, we've actually finished point 7 when we did Mr. Genie. So we can go to page 4 of our question and deal with point 8. So point 8 says a cement mixer, which is equipment, right, was serviced by NHC. As part of the service, engine oil, right, which is something that we sell, engine oil and some minor parts were changed in the cement mixer. So basically what's happened is we needed to do a service on our equipment. In order to do the service, we actually used some of our inventory, okay, to do the service. Now we need to understand, should we be increasing the value of our inventory, of our equipment when we do the service? Now ask yourself, when you have a vehicle, when you have a car, right, and you take your car to get serviced at the mechanic, or the mechanic, he changes the oil, he changes, maybe the light bulb or something like that in the car. Does it now mean, so if you had a Polo, you took it for service, does it all of a sudden become a Mercedes-Benz? No. So that means it's clear that the value of that asset has not changed because of the service. So for us to say we're going to capitalize or debit equipment for the service is incorrect. because this is a service just to make sure that this item, this asset, continues to operate and reaches the end of its useful life. So we can't be capitalizing or debiting equipment for the value of the service. Does that make sense? Okay. So we then hear that the inventories that we were wanting to sell the inventories that we used at least would have sold for 1,500 Rand, and we have a cost plus markup of 50% on cost. Okay, so we need now to figure out how do we move from selling price, right? How do we move to cost price? Why? Because if we as the business purchased inventory, let's say we purchased it and we paid 1,000 Rand, right? Then we use that inventory to fix our equipment. Okay, what is the total cost to the business? The total cost is the amount that we paid for the inventory at the beginning. So if we paid 1,000 Rand at the beginning, that is the total cost. So it doesn't make sense for us to record the selling price of the inventory, right? Because that's not what we paid. That's not what it cost us. It cost us 1,000 Rand. So we need to be recording this specific expense. We record it at the cost price, right? And that was the test. That was to see if you knew that we need to be recording this at the cost price and not at the selling price. Okay, so what you'll see is what we do now is we say debit expense, right? Why expense again? Because it's simply an expense incurred to make sure that this asset reaches the end of its useful life. It doesn't improve the asset in any way. It doesn't make the cement mixer faster, better, look nicer, worth more. No, it doesn't increase the useful life. It doesn't mean it's going to last 10 more years, 5 more years, 1 more year if we service it. No, it doesn't increase the residual value even. So the only thing this is an expense because there's no congruent increase in the value of the asset. Because there's no matching increase in the value of the asset, it means we cannot capitalize it. We have to expense it. Therefore, you're seeing debit repairs and maintenance, or we also accepted service expense. Okay, and we will also then credit our inventory. Some people said consumables. Very happy to give you the mark for that. Okay, and how did we get to the amount? We actually excluded. Remember, we said in class, I showed you that that thing, and I said what you want must be at the top, right? And what you have must be at the bottom. Can you remember? I showed you that diagram where I said if you're calculating anything to deal with like selling price and that, you must just use this formula where I said what you want at the top, what you have at the bottom. So what we have is the selling price, which represents 150%, right? And what we want is the 100%, which is the cost price. So that's why we went with 100 over 50, right? And we then got an amount of 1,000 Rand, which we record as an expense. Okay, let's go back to the question. We also see that 8.1 talks about depreciation. Now we know the depreciation should be recorded on the 31st at the end of the month. So we'll go to page 4 of our solution, and there right at the bottom we will see depreciation and accumulated depreciation equipment, and the amount is copied directly out of our question. Okay, so the 12,500 comes directly from the question. Now, let's have a look at 9. So 9 says we've received liquidation documents from Sandile Legal. These documents indicated, right? We've received the documents. Notice what have we received? The documents. right? Because I noticed there was an error that a lot of students made. We've received documents from Sandile Legal. Tabo Construction, one of our debtors, has filed for bankruptcy, and we should expect 20 cents in the rand. That means in every rand that they owe us, we should only expect that they're going to pay us 20 cents out of that rand. So 80 cents they're not going to pay us. That's basically what we're reading. Okay. It then says the outstanding balance owed by Tabu Construction on the 20th of January was 5,000 rand. The recoverability of this debtor was never in question in the past. Therefore, we did not raise an allowance for credit losses for this specific debtor, right? Which means we should not be processing anything to deal with allowance for credit losses. That is not what this has been asking us to do, right? It's not an error that we're trying to correct. We're telling you that you can't fall back on any allowance. That means you can't unwind any allowance that you had previously raised for this debtor, right? Like how we, for example, would unwind a prepaid expense when the expense arrived. We can't unwind the allowance because we never allowed for it at the beginning, right? At the start. So what we need to now do is, firstly, we need to identify that this does not tell us that we are getting a payment from Tabu Legal today. Okay, it's saying we should expect, so everything is future tense. The only thing we've received from Tabu Construction, at least, the only thing we've received is the legal documents. So the fact that many students were saying debit bank, right, credit the trade receivables for the 20 cents in the rand, which ends up being 1,000 rand, that's incorrect, because that's not what we're reading here. What we're reading is we should expect in the future he's going to pay us 20 cents. The only thing we've received today are legal documents, not rands and cents. Okay, so there's no bank involved in this transaction. So let's now try and record this. Basically, what we need to do is write down this debtor, right, this trade receivable, down to the amount that we think we're going to receive. So what do we think we're going to receive? We're going to receive 1,000 rand, which is 20% of the 5,000 rand. Okay, so we're not going to receive 80%, which is the 4,000 rand. Okay, so we need to eliminate or get rid of that 4,000 rand, because currently our debtor is recognized at or showing at 5,000. So we need to decrease it by 4,000. Because we want to decrease our debtor, we should expect that we should be having a credit trade receivables, right? So here you can see what we do on the 20th of January is we credit trade receivables. We then debit our credit losses, or if you said bad debts, that was fine. And the amount is for 4,000 rand, because we want to decrease it. Notice there's no transaction for the 1,000 rand. The 1,000 rand stays or remains in trade receivables. The question never told us that we were being paid. Instead, the question was always talking in the future tense. The only thing that we received on the 20th were legal documents, not rands and cents, not cash. Okay. Then on the 20, so the information point 10 we already did when we did Genie, when we spoke about Genie. So on the 28th of January, now this is in information point 11, Mr. Hall took sandpaper. The selling price of the sandpaper was 1,050 rand, and the cost price was 700 rand to complete a project at his home. So this was clearly personal use. How do we know it was personal use? Because he was doing something at his home. Okay, he was doing something at his home. Right. So what we then do is we debit drawings, credit our inventory, because our inventory is decreasing because we know that we sell sandpaper, right? We read that in the information right at the beginning. So we credit our inventory, we debit our drawings, and the amount is 700 rand. Why is the amount at cost price and not selling price? The argument is the same as when we were speaking about point 8 and the equipment, because the company has only paid 700 rand for the sandpaper. We never paid 1,050 rand. So the cost to the business is 700 rand. It cannot be the selling price. The cost to the business cannot be the selling price because we never paid that cost. We only paid 700 rand. So therefore, we only record the cost price as a decrease in inventory. Yeah. So the last bullet point for this question is point 12, where it says that we've got an amount of 600 rand that was received from builder base construction, right? This amount was in relation to the trade debtor who was owing 800 rand, right? But had been written down to 200 rand. So he was at 800 rand. We wrote him down to 200 rand, but now he's paid us 600 rand. So he's paid us more than he owes us. So that is a bad debts recovered, where they paid us more than they owe us. Right. So what that means is we're going to first process a normal payment of a creditor, of a debtor at least, because he owes us 800 rand. He owes us 200 rand. So we process the normal payment first. We do that. By on the 30th of January. Basically, what we do is we say bank trade receivables for 200 rand. And then if you wanted to, you could actually separate this journal and then say bank 400 rand, credit loss recovered or bad debts recovered, 400 rand. So this is a combination journal, but that is how we're supposed to record, that transaction. So if you did not have credit losses recovered or bad debts recovered, you clearly did not understand what the question was asking. So you have to be super careful about what the question is asking. Okay, so that brings us to the end of question 1. Guys, thank you for listening to me. If you want to know the ins and outs of question 2, then watch the next video in the series. And if you just want to know how to mark, then you're going to skip right to question 3. Thank you again and have a good day.